Welcome, everybody, to News of the Money World. My name is Darcy Ungaro, and your name is Rupert Carlyon. Rupert, how you going today?
I'm very good. How are you?
Very good, very good. I must say I'm a little bit tired just watching the news. In the last 24 hours, it's been phenomenal. We were complaining maybe only like 6 weeks ago, right? Around the lack of news, where it was just kind of like same, same. We don't really have that problem anymore, do we?
No. I mean, this morning I made myself very unpopular at home by making sure the kids watch Bloomberg versus watching the Olympics because there's so much happening and it's fascinating figuring out how we unpick it all.
Yeah. So, the best place to start really is at what we think might be the beginning, but there are a lot of factors going on that's led to a little bit of a market meltdown. Depending on your natural bent, you're going to be like screaming, the sky is falling, cash your chips up, run for the mountain. Or it'll be, hey, this is a normal drawdown. It's to be expected when we have real steep periods of growth. We're going to get these bumpy patches along the road. So let's start with the Japanese yen carry trade and the reversal of this. We spoke about this a little while ago. So the general idea is that investors can borrow for basically next to nothing in Japan, take that money to other markets, let's say the United States, where the return is a lot higher, kind of like a risk-free return. That gooses up asset prices even more. And meanwhile, the Japanese yen depreciates against the US dollar partially because of this going on. So when the debt needs to get repaid in Japan, it's being repaid, like lower dollars are being repaid. So it's this great positive feedback loop, and it works great so long as volatility is like low and falling, so long as the Japanese yen continues to lose value and their interest rates stay low. But we're now at 0.25% interest rates. The Bank of Japan has done that, and now that's triggering a reversal in that yen carry trade, and it's the yen dump trade, and things have been dumping. Now, that's one of the factors at play. We also have unemployment data. We have Middle East conflict growing tense by the hour, just waiting for that one to drop. And things are kind of starting to happen, and feedback loops are starting to happen where platforms like Robinhood, Fidelity, Charles Schwab, Vanguard, TD, Ameritrade, they're just shutting down. These circuit breakers are kicking in because of the rate at which things have dropped. So, yeah, what's your take on the last, say, 48 hours, especially?
It's been a fascinating world. So we'll start on everything kind of kicked off on Friday morning before the markets opened in the US. We had the US Department of Labor. They released their monthly job statistics. And to be blunt, they were pretty average. We saw jobless claims. We saw the unemployment rate actually shot up from 4.1% up to 4.3%, skipped 4.2% on the way through. And look, before this, and you also had manufacturing PMIs, which are in the US, so the kind of the services, the ISM, which is basically a basket of a whole series of manufacturing indexes and economic factors that came in significantly weaker than the prior month. And so this all hit at a time where investors were already starting to go, hold on a sec, we're not quite sure about where we're at. We're not sure on where the markets are at because they're all pretty high. And all of a sudden you go, bang, these two bad pieces of news on top of some pretty shitty results from Amazon, some not so great results from Microsoft. And everyone goes, okay, that's it. This is the catalyst we've all been looking for a long time. The catalyst, really, the unemployment data and the ISM data, what that's kind of all of a sudden said to everyone is actually maybe the US economy is about to hit recession because the only times in history where the unemployment rate has moved this fast has been when we are kind of heading straight into a recession at pretty high pace. And I think this is giving people a huge amount of nervousness all over the world because it's been the US economy which has held up the global economy over the last little wee while. And so this kind of hit on Friday morning. Immediately on Friday morning, we saw kind of the markets in Friday down about 2.5% as they kind of reacted to this recession trade. And then yesterday, so we're filming this on 6th of August, but kind of 5th of August in US days. Last night, we actually saw this get a whole lot worse and markets were down another 3.5% last night. And I think we're starting to see the global impact of a whole lot of this as well. So we saw the yen and the Japanese market carry trade, where all of a sudden we're going, well, if we're heading into a recession in the US, that means interest rates are going to have to tumble. and all of a sudden the carry trade that you talked about earlier, that no longer exists. So we've seen the yen spike by 5-10%, or sorry, the yen has spiked by 3% overnight, but that's actually up 14% over the last couple of weeks. And as a result, we've seen the Japanese market that dropped 20% yesterday. And that's by far and away the strongest move in the Japanese market, equity market, since 1987. We need to remember that the 1987 peak, we actually only just went through that peak a couple of months back. So, yeah, really interesting time, both globally, but also particularly with that Japanese stuff that's happening as well.
That last part there around how it's basically taken 30 years to reach that same sort of neighborhood in the Nikkei index. And then within the space of like 24, 48 hours, it just unwinds that now, right? Like a 20% drawdown is, that's not nothing. That's something. Like, it's not unusual to see the odd 3 every now and then where things drop at 20%. It's quite phenomenal, right? And I just wonder if that is like, is that the end of it or is that the beginning? Because these trends, like the crowd is yelling louder for the US Fed to drop interest rates further, faster. Like, I think economists, market participants are kind of thinking, hey, we might see 1 to 1.5% come off that Fed funds rate by year end. If that actually happens, then that's not going to make the unwinding yen carry trade much better. And so do you see this as a blip, or are you kind of seeing this as maybe this is act one and we have further layers of this onion to peel?
I think we've got to unwind it, right? And we've got to unpick. To me, there are 3 separate components, which are probably 3 or 4 separate components, right? So we've got the first big question of, is the US heading into recession? And kind of have interest rates stay too high for too long? And then what that does is the answer to that will determine 2 parts, right? It'll determine how fast do interest rates need to come down. And I mean, Citi came out overnight they're talking about now 1.25% drop in interest rates between now and the end of the year, which is amazing when you think about it. But so that's the first question, right? Are we heading into recession? How far and how quickly do interest rates need to come down? That question will also drive the Japanese yen and the kind of the Japanese carry trade. Because what we've also got is, as you kind of mentioned at the start, one of the big reasons for that carry trade has been the interest rate differential between US and Japan. And what we've seen over the last couple of weeks is we've seen US interest rates start to drop and interest inflation continues to stay high in Japan. And we're seeing actually the potential that the Bank of Japan might need to go up. And so I think those are they're related, but they're also quite separate as well, right? And then the third thing that we've got going on, which is impact number 3, is tech's gone on a massive run over the last little wee while, the last kind of 12, 18 months. And again, highly valued, trading at a 50% premium to the rest of the market. They're delivering some amazing growth results. And kind of a lot of that's off the back of this AI trend. And increasingly it's becoming clear that, you know what, maybe we're just not going to get the AI-driven growth that we thought we would. And so I think there's kind of this accumulation of all of these 3 things that we need to kind of unpack and to kind of think about separately. And so if we start with kind of the Japanese yen carry trade, which is where to me, 20% drop in the equity markets. Look, if I think about kind of, is the market now, have the Japanese corporates, are they going to be earning 20% less this year because of what we now know over the last 24 hours? It's really hard to believe that that's the case. So to me, that kind of says maybe this is just a little bit of overdone. This is a little bit of the markets going, hey, we've been waiting for some bad news. And when we start to see the bad news, we kind of let this follow through. In saying that, that's the equity component of the Japanese trade. The FX component, are we likely to see an unwind of kind of that weakening of the yen? Probably, because that interest rate differential is nowhere near as strong as it has been, and that is likely to unwind, particularly if we see the Japanese called the central bank in Japan keep on potential to increase interest rates, and we know what's about to happen in the US, where they're going to start coming down pretty quickly. The one thing I would say, though, which is important, is over the last month, Japanese equity market is down 20%. The Japanese yen is up 14%. And so that means actually if you're an offshore investor in the Japanese yen, you actually haven't done too badly. And you kind of, your overall performance isn't broadly out of line with where the US markets have gone as well. So do I
Yeah.
think this is a little bit of a blip? I think the equity markets is a blip. And I'd be surprised if kind of it goes any further than that. But I do think that the currency markets have potentially a bit further to go as we see a whole lot of this carry trade unwind.
Okay. So, and there's a lot in this, so we'll try and skip over some things which will get us
Huge,
stuck
man.
into a rabbit hole. But with the FX unwind, so the exchange rate, the price of the yen, obviously that's sensitive to what interest rates are going to be in Japan, as well as what's happening in the US, right? In terms of the rate at which they do
Yep.
end up decreasing the Fed funds rate in the US will determine the value of the dollar over there. And so one of the things that we learned following March 2020 was that, hey, when interest rates go low, like this wasn't new information. I think a lot of people realized this sooner, but it was really, really obvious following March 2020. When interest rates go too low and they stay there for too long, it really sets assets alight. My curiosity here is that I wonder if we're going to see some version of recency bias kick in and cloud some investors' judgment, thinking that, hey, if interest rates are going to come down further faster, then that means we should just ape into everything we possibly can. It should be risk on. But we forget
Yeah,
the
and I
fact that
think
interest rates. Go ahead.
fuck,
We lost you.
breaking up actually for a sec. I don't know why we've lost.
Have you
Hey,
lost
is
me?
it pretty blurry on your end?
No, it's in and out. You're
Yeah.
you're good. You're good at the moment.
Okay, I'll just a sec. Sorry, while we're
That's
pausing,
okay.
my phone keeps on beeping, so I'll just turn that off.
Same here. It's just alerts.
Okay, sorry. Do you mind? I kind of lost you halfway through.
Okay,
I
let me
was struggling
let
to
me
keep up.
good because I didn't finish my thought anyway, so that's good. All right. Following March of 2020, then we saw interest rates go really low and stay there then for too long. We learned the lesson that low interest rates ignite asset prices. And so my concern going forward is that as the market sees the need for interest rates to fall further faster, because the Fed was too, they're always behind the eight ball, right? My
Yeah.
assumption is that due to recency bias, investors will ape into risk on assets without realizing that the need for low interest rates exists because of recession. And that part hasn't really been factored in. And I think that there is a little bit of risk that interest rates could drop quite quickly, but then go up really high because of wallpapering over the cracks, injecting liquidity to keep the system going. What do you see going forward in terms of like that FX unwind piece where the yen might increase in value, the US dollar might decrease in value, and we might see a reacceleration of this yen carry trade, which creates more liquidity and then lower interest rates, which ignites more instability. It sounds to me like there's a decent feedback loop risk happening. What do you think of the odds things could get a little bit unruly here?
Well, I think there's two parts, right? I think your analysis is 100% spot on. The only thing is, I think if we're focused on equity markets, equity investors, to be fair, have been petrified for the better part of the last 6 months about what's happening. And they've kind of been saying, well, actually, let's call it 18 months and going, when is this recession happening? And when is this recession happening? And even kind of with that move that we saw last month, where we switched out of NASDAQ kind of large caps and into the Russell 2000, there was kind of, we saw this, it was kind of, that was the start of the unwind of that trade, which is a little bit paradoxical that now it's going to have to quickly rewind. But where we've kind of got investors are still nervous. They're still nervous about very high valuations. They're nervous about the impact of the recession. So I actually suspect this time the recession chat is going to be far more impactful than the talk of falling interest rates and what that does to asset valuations, because the broad equity base and investors have wanted to have this conversation for the better part of 2 years. And I think that's why it's all of a sudden going, it's the markets and the data for once has delivered what they want. And so that's why they're actually, I think they're going to lean into it personally.
Got it. Like
Does that make sense?
yeah, it does make sense, and it's kind of like when a volcano goes off. I was watching a video of the 1980 eruption of Mount St. Helens. I was quite young when it happened. I was sharing that with my kid. But what happened was there was this big bulge on the side of the mountain before it blew up, and so there's this pressure that builds, and all it takes is a little bit of a catalyst, like an earthquake, to trigger it, right? But it's an underlying pressure that builds up, and these other forces kind of keep it in check. But at some stage, if the market is screaming, hey, there needs to be an adjustment and a recalibration of expectations here, then it just takes a bit of a trigger to get there. But when it gets there, the pressure is relieved, right? I know it's a completely wild sort of analogy there, but is that kind of right?
No, 100%. Yeah, that's exactly the right analogy. I think that's really great. But and then the bit that I find second and more interesting. So we talked about the three factors earlier, is where you come to the tech, right? Because and these companies are highly valued. There's no question on it. But most of them are delivering kind of double-digit growth, apart from Apple. Everyone else is delivering double-digit growth. They are absolute cash flow behemoths, very strong balance sheets. And so we're all sitting there going, oh, they're too expensive, they run too far. My big challenge to people is, well, what else do you want to own in this environment, right? I mean, personally, I think Microsoft is the best company in the world. And it is as recession-proof as you get. Facebook, Google, Amazon, in my mind, they are all recession-proof because they have the size, the scale, the presence that's going to allow them to kind of see through this downturn. And yeah, that's why I'm kind of in two minds and going, actually, can they deliver, if they can deliver the earnings that they forecast, and they can continue to spit out the cash flow that they're forecasting, I think they probably justify the valuations and where they sit. My exceptions on this list are Apple and Tesla because they aren't growing, and so they need to be looked at slightly separately. And then Nvidia is the only one left, and you go, how has this conversation changed so much from a month ago? We were talking about the fact that they couldn't produce enough chips and they've got a backlog which is 2 years long, to that backlog is still there, but all of a sudden the hype is overblown. And so yeah, I'm kind of struggling a little bit to see why the market has gone so far and why the market is so nervous on technology here.
Yeah. I don't know. I think I get what you're saying. Within a spectrum, if I was to guess, yeah, like that earnings probably does have a certain degree of pricing power. There's still a lot of fundamental reasons why those earnings should persist to a point, though, right? Like I have Copilot with Microsoft. I have an OpenAI account that I pay for. And then I have X Premium. So I have 3 services that are all kind of like pure AI just to help me with content creation and spell checking, basically, right? What's the first thing that's going to go hopefully not when, but if things got really bad in terms of recession? Well, it's probably going to be at least 2 out of those 3 services, which are quite similar. And I just wonder if that dynamic, I know it's quite simplistic, but I wonder if that dynamic will be at play when if recession gets so bad that people have to start cutting things. I wonder if that inevitably will hit those earnings. Don't you think that's
It is, but I think 2 parts, right? You got to remember, when we're valuing businesses, we're valuing them over a 10, 15-year horizon. We're not valuing them over the 2-year horizon of that recession, which is easier said than done, and I accept that. The second part, coming back to Microsoft, I mean, I think about us as a business, right? We use them every single month. Let's be honest, 90 to 95% of their revenue comes from that core business kind of PC market, and even the home PC market, and that stuff's not going anywhere. And if they really wanted to, if they could put up their prices by 5%, businesses might squeal a little bit, but there's actually not much we can do because they're such an integral part of where we're at and what we do. And so that's why I do think they're the best company in the world, and they're kind of one of the greatest investments you can make, because it's very rare that you have a company like that is so integral to your life. You might get rid of the extra shiny shit that sits on top, but the core platform of which you pay the first $50 of your $60 for, you can't live without it.
That makes sense. Yeah, no, I accept that. That makes a lot of sense now, and not financial advice. We're not saying, hey, let's all stack.
No, I'm not plugging Microsoft.
Microsoft or Berkshire Hathaway. So I'm just reading one of the many tweets that I'm seeing coming out here. Effectively, there's Berkshire Hathaway, so Warren Buffett's fund. Berkshire Hathaway is effectively a 70-30 portfolio now, and with the amount of cash that they are sitting on. Sells 49. He sold recently 49% of his stake in Apple. Obviously, they believe that there's going to be better buying conditions soon. So I guess as this comes full circle to what we were saying here, some of the biggest investors are expecting a decent drawdown, staying in cash, going more into cash as time comes, as time passes, and specifically getting out of these tech stocks. Now, granted, Warren Buffett isn't necessarily a futurist, so maybe that's what's going on here. But do you think that that means something? Do investors, like I know a lot of investors do watch what Warren does, but do you think that's sending a signal to the market?
I mean, personally, I find the Apple story really interesting, right? Look, they've got an amazing ecosystem, an amazing smartphone market, but their whole world relies on people continuing to buy even more expensive iPhones. And they've had 2, 3 years of actually negative earnings growth and negative revenue growth, and they're still valued at a premium. Are they going to go away? No. But the big challenge to Apple is when you've got a fully saturated iPhone market, which I think the evidence is increasingly showing that they've got, how do you continue to grow? And how do you continue to grow the services side of their business, which is kind of supposedly where all the growth is going to come from, when actually you're no longer the innovators and you're not the ones that sit kind of at the center of that world. And the big risk that you have with Apple is that actually they turn themselves into another Samsung. And that they kind of become a product and a device manufacturer rather than an ecosystem, which is kind of where I think everyone was hoping that they would go, right? I mean, even down to the fact that they had a massive rally in the last couple of months or last month on the basis of simply that they were going to put ChatGPT, integrate that into Siri. That doesn't feel like something that excited, but that still provided like a 4% bump to their share price, which is kind of where the market was at. And you go, well, if Apple can integrate Siri and ChatGPT, Samsung and Android definitely can as well. So that's not really a differentiator. If anything, that pushes them back into that device world. And so my guess is that this is a little bit of where Warren Buffett's coming from, going, yeah, there's a little bit of me going, hey, actually, you know what? It's a very expensive company. It's a brilliant company, but is it still that same kind of growth play, or is it actually a mature kind of device company moving forward?
Yeah.
Each of these, and I think that's the challenge with all of these tech companies. We lump them all together, but they've each got their own story, right? So in Microsoft, it's that business kind of SMN, business kind of in Apple, it's about the devices, and actually are they a manufacturer? Tesla, well, I think Tesla's just a car manufacturer personally, and I'm kind of amazed that they trade at such a premium to start with. Then you've got the Nvidias, and I kind of buy that story because they're the only ones that can do what they do. Facebook, it's an advertising story, as is Google, right? And each of them have got their own stories, and I think we've gone for a long time with this, what's happened in the market over the last 2 years. We're just very good at lumping them all together, right? And we're waiting for the word AI, we're waiting for whatever the word is. And then the moment we hear it, we go, awesome, done, that fits in that box, let's go.
Yeah. You know what this reminds me a lot of, though, is the crypto market, where similar to tech, lump it all together. But when you look really closely, there's Apple, Amazon, Meta, Microsoft, etc. And they all have their different little niches, and technology is advancing their business in ways that we can't really anticipate. But it is similar, but it's not homogenous. And cryptocurrency is really just a form of money. It's just existing in a digital format. It's a digital asset, right? And so Bitcoin, you have your financial, that's kind of like a financial blockchain. Ethereum infrastructure blockchain, like a lot of the stablecoin ecosystem uses Ethereum. Solana, there's your retail application in terms of blockchain, and others, right? But when you look at crypto, it's easy to kind of just look at it as one market. But what I've learned recently is that no, there is a lot in crypto to get excited about, and you don't have to like the whole thing, but to disregard it would be equally foolish. But one of the things that I saw just recently was just how fast it can drop, because it's trading 24/7. It doesn't take a break. There's no circuit breakers that apply in this ecosystem. Robinhood won't shut down your crypto wallet. So you will see where the market really is without any intervention, good or bad. And it's really interesting just to see how things are all still correlated. But I suspect that over time, what we're going to see with the tech thing is we're going to see things break apart a little bit, And even though tech right now might be very correlated to sentiment around interest rates, I think we might see some individual companies have different rates of correlation to each other just based on how everything in the future evolves. Same thing with crypto assets. I think we're going to see things dance to a different tune depending on where we're at in the future, right? There's so much going on. I don't even know how to finish this one, Rupert, but what should be the last thing that we talk about just to kind of tie a bow in this conversation today?
Well, I think the one thing that we've talked a lot about, right, today, and probably more so than ever, is a huge amount of supposition and a huge amount of guesswork around where it's going to go, and a lot of moving dynamics, right? And I think one of the big things that kind of what we always say is going, let's be honest, no one really knows what's going to happen. No one really knows where we're at. And I think times like this are what make being an investor either interesting or being hard. And I think from my side, it makes it really interesting. It makes it hard because our clients are losing money. But
Yep.
my job as a manager and someone that's advising clients is to make sure that they stay confident, make sure they stay focused on the long term. Because, you're going to read lots of headlines over the next couple of days. You're going to have, I guarantee, the Herald tomorrow morning will have market meltdown, will be their headline. It'll be all over the place. But the trick is not to react because no one knows, and lots of people will tell you they think they know. Is it going to drop another 10% over the next couple of days? Or does it quickly reverse? And the moment you try and take some bets on that market move in that direction, that's when you lose.
Yeah. It's so bizarre how the market can successfully rip everybody's face off without leaving anyone out, right? It's phenomenal. It's very fair like that, I think. And but yeah, you do have to kind of take a long-term look because if you can't handle this volatility that we're seeing right now, you probably aren't really in possession of the amount of risk tolerance that is required to get the return which is above average. And I think that's the part that like people often look at the investments themselves and they forget to look at themselves. It's always about the investment. Invest in that. Yeah, it's bumpy along the way, but you're going to get a great return. They forget to consider what the feedback is when you're viewing that volatile investment, what it does to you. But if you can survive during times like this, when we see severe market pullbacks, then it means that you are made of the stuff that's likely going to get a good return because it's always about the hands that hold it, not the assets themselves. And like investing in term deposits and bond funds and repaying your mortgage early, those are viable options if you cannot handle anything like what we're seeing right now, right? It's just a good reminder. I think as every year where we get a marginal improvement overall in the market, we forget that lesson. But yeah, when you chase more than average, you're gonna get hurt every now and then, right? And that's okay. That's the way it rolls. Awesome. Well, let's bring it to a conclusion. Let's bring it to a soft landing. Not that that can be engineered, clearly. And next week we'll continue to see where this evolution of the market goes, and hopefully we'll see a couple of new other little nuggets that we can dig into a bit further. Thanks for the chat today.
Awesome. Well, thank you, Darcy. And hopefully next week we're talking about the short, sharp crash that was quickly reversed. That's my hope.